Welcome to the video. First, we will frame the real enemy of long-term retirement wealth: unnecessary investment fees. Then, we will walk through how typical high-fee advice slips into 401k portfolios, why it hurts your outcomes, and exactly how to fix it with low-cost, broadly diversified options. Throughout, we will use clear visuals and examples, and we will finish with a straightforward action plan you can implement right away. Next, here is our agenda. We will start with the investor's dilemma, then examine how the fee trap forms in many 401k plans. After that, we will quantify the compounding impact of fees, outline smart moves, discuss target date funds as a simple solution, test your understanding with quick quizzes, and close with key takeaways and next steps. First, let's consider the investor's dilemma. Young professionals often want to optimize every angle with aggressive and complex allocations: small caps, value tilts, international diversifiers. While diversification is essential, real-world plan menus frequently steer people into actively managed funds with much higher expense ratios. Unfortunately, the complexity rarely justifies the excess costs, and those costs compound against you for decades. As you'll see, this dynamic becomes a silent drain on retirement outcomes. Before we proceed, here is a brief but important disclaimer. This content is educational and not individualized financial advice. Past performance is not indicative of future results. Your specific 401k plan, fund lineup, fees, and employer match will vary. Always review your plan documents and consider speaking with a fiduciary financial advisor before making changes. All examples are illustrative and simplified for clarity. Now, let's unpack the fee trap. Many 401k menus pair an excellent, ultra-low-cost S&P 500 index fund with a list of actively managed funds charging 0.5% to nearly 1% per year. Investors often end up with a custom blend that looks sophisticated but embeds substantial, ongoing costs. Over decades, those fees compound in reverse, meaning you pay them every year, reducing the effective growth of your savings. The brutal truth is that high-fee active funds rarely justify their expenses consistently over long horizons. The better approach is to prioritize broad diversification through low-cost index funds, with expense ratios under 0.10% when possible. Next, the flowchart illustrates the decision path when selecting 401k investments. You start by asking whether your plan provides low-cost core index funds. If the answer is yes, you select funds with expense ratios under 0.10%. Then you decide whether you prefer simplicity. If so, a low-cost target date fund is a great one-and-done option. If not, you can build your own core mix. If your plan lacks ideal low-cost choices, you still pick the best available low-fee funds and minimize costs wherever possible, then revisit each open enrollment to improve your lineup as options evolve. Meanwhile, let's quantify fee drag with an approximate timeline. Assume you contribute $6,000 per year for 30 years, with a roughly 7% gross return. Your net return is the gross return minus your portfolio's expense ratios. For example, 7% minus 0.5% equals 6.5%. Over 10, 20, and 30 years, that small-looking difference compounds into very large gaps. The timeline shows that even with the same market, higher fees can reduce outcomes by many tens of thousands of dollars. Because markets are unpredictable, controlling cost is the most reliable advantage you can lock in today. All numbers are approximate and for illustration only. Additionally, this table provides a simplified illustration comparing different expense ratios for a 30-year period with $6,000 contributed annually. At 0.03%, your net return is about 6.97%. Yielding approximately $563,900. At 0.10%, the outcome is around $555,700. At 0.50%, the result falls to roughly $518,800, and at 0.80%, about $491,600. The differences relative to the 0.10% scenario highlight how fee drag compounds into large dollar amounts over time. These are rough estimates for educational purposes only. Moving on, let's compare high-fee active funds with low-cost index funds. On the high-fee side, expense ratios typically range from 0.5% to well above that, and those costs apply every single year. Over long horizons, the average active fund struggles to outperform after fees, and the lineup can become complex, with risks like style drift or manager turnover. On the low-cost side, broad index funds often charge under 0.1%, provide transparent market exposure, and are straightforward to monitor and automate. For most investors, the combination of broad diversification and super low fees leads to better long-term reliability. After that, here is your action plan. First, audit your 401k lineup and list each fund's asset class and expense ratios. Second, prioritize core index funds with expense ratios under 0.1%, such as a total U.S. market or S&P 500 index, an international index, and a bond index as appropriate. Third, if cheap core funds are unavailable, consider a low-cost target date fund. Fourth, consolidate positions, removing redundant or expensive funds except when there is no viable alternative. Fifth, automate contributions and rebalancing so you remain consistent through market volatility. Finally, review your plan at each open enrollment to capture any newly available low-cost options. Next, this pie chart presents an illustrative core allocation. The example emphasizes a strong core using a U.S. total market index at 80%, complemented by an international index at 15% and a bond index at 5%. The exact mix should reflect your risk tolerance, time horizon, and plan menu. The key principle is to use a few broad, low-cost building blocks rather than many expensive, specialized funds. Now let's talk target date funds. A target date fund provides a diversified, age-appropriate mix in a single investment and automatically adjusts over time. However, the fees vary widely. Some providers offer target date funds under 15 basis points, while others charge significantly more. Always check the expense ratio before choosing. If your plan's low-cost core index funds are limited, a low-cost target date fund can be a practical one-and-done solution that keeps you broadly diversified and on track. Next, here is a quick quiz. The question is, which has the bigger long-term impact on your 401k growth? Option A, a 5% tilt to small cap growth. Option B, a 0.5% higher expense ratio. Option C, quarterly rebalancing instead of annual. Or option D, choosing an international index over none. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Now for the answer. The correct choice is B, a 0.5% higher expense ratio. Even small fee differences compound dramatically over decades, and the lost growth often exceeds the benefit of minor allocation tweaks. This is why minimizing expenses is such a powerful lever for long-term outcomes. Next, here is the second quiz. The question is, what is a sensible expense ratio target for core index funds in a 401k? Option A, under 0.1%. Option B, under 0.5%. Option C, under 1%. Or option D, any expense ratio is fine if the name sounds good. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Now for the answer. The correct choice is A, under 0.1%. For core building blocks, you should seek ultra-low expense ratios. If your plan does not offer those, the next best option may be the lowest cost target date fund available. Furthermore, the timeline outlines a simple process you can follow. In Week 1, audit your current funds and their fees. In Week 2, select low-cost core index funds or a low-cost target date fund. In Week 3, automate contributions and rebalancing. Each quarter, review your contributions and fee levels. During open enrollment, reshop your plan lineup for newly available low-cost options. This cadence keeps you proactive without becoming burdensome. As we near the end, here are the key takeaways. High fees are the silent killers of retirement wealth. Prioritize core index funds with expense ratios under 0.1%. If your plan's options are limited, consider a low-cost target date fund. Simplify and automate your approach, then stay consistent through market noise. Finally, revisit your plan during each open enrollment to take advantage of any cost improvements. In summary, complexity without a cost check is risky because fees compound against you for decades. Low-cost core exposure typically outperforms expensive complexity over long horizons. Do the simple things relentlessly. minimize expense ratios, diversify broadly, and automate. Remember that your 401k is a marathon, not a sprint. Control the variables you can, and cost is the most reliable lever available. Finally, thank you for watching. If you found this helpful, please like the video, share it with a friend, and subscribe for more practical investing guides. I would also love to hear your fee hunting tips and experiences in the comments. See you in the next one.